Good afternoon, ladies and gentlemen, and welcome to the ARGENTEX Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, if I may, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Harry Adams. Good afternoon, sir.
Thank you, Jake. Good afternoon, everyone. Thank you for joining us for the full year Investor Meet presentation. Hopefully you all know me. My name is Harry Adams and I'm Chief Executive and Founder of ARGENTEX.
Hi, everyone. Joe Stant, CFO here at ARGENTEX.
Afternoon, everybody. Dave Christie. I'm the Chief Operating Officer here at ARGENTEX.
So just a bit of housekeeping before we start. As a reminder, due to the internationalization of the business, we have changed our year end. The reported period is for the 9 months from the 1st of April 22 to the 31st of December 22, and this will be referred to as 2022, whereas FY22 refers to the full last year, which is the 1st of April 21 to the 31st of March 22. Now, clearly there's not much point comparing 9 months with 12 months. Therefore, throughout this presentation, we will give you 12 months comparisons where relevant, which is the calendar year of 2022. Hopefully that is all nice and clear. So firstly, I'd like to open with some takeaways from the reported period. Last year, we laid out our new growth strategy and we were transparent about the investment required to take this business to the next level and beyond. This reported set of results clearly evidences the successful execution and implementation of the strategy, with the investments paying dividends quicker than anticipated, as revenue growth exceeded all expectations, with operating margins also ahead. This demonstrates the potential of the business as we remain focused on growing revenues, increasing profitability, and continuing earnings quality over the long term. The market remains wide open for disruption, with significant opportunities for us as our product set and global reach expands. Hopefully you're familiar with the fundamentals of the business and have tracked our journey from low-tech, high-touch FX brokerage to where we are today, a high-touch, high-tech enabled currency management and payment specialist. This transition has been driven by addressing evolving customer needs through focused strategic investments that are now delivering results. We have made some significant operational improvements to the business since 2021, but what has not changed is that we remain debt-free, well-capitalized, and cash-generative. Although the three of us and the other execs have not worked together for a long period of time, the experience and track record of the cohort speaks for itself. We've established specialist teams in our core markets, offering our clients, who tend to be on the more sophisticated end of the spectrum, a growing suite of products. Thanks to this increase of products, our revenue is now not just generated by FX spread, but also generated from payment charges and annual account fees. Of course, we continue to scale the business in a sustainable manner. Our client base has never been so diverse, meaning that we're not overly exposed or reliant to any one sector or currency. Now, this bar chart in the bottom left serves three purposes. Firstly, to demonstrate that the organic revenue growth has been solid since 2018. Secondly, to validate as to why we focus on corporates and institutions, as their requirements are repetitive to pay suppliers, as an example, rather than one-offs to buy holiday homes for private clients. And finally, to show that our sales pods hit their stride in the last 12 months with a 40% increase in new business. The opportunity that is right in front of us is quite unique. Our addressable market in the UK, Europe, and Australia for currency management alone is vast and highly fragmented. It is estimated that 85% of UK corporates still use their relationship bank for their FX, from whom they receive poor pricing, little flexibility, and a deprived service at best. Banks client onboarding is also arduous and incredibly slow, meaning more and more corporates and institutions are looking outside their bank for credible alternatives who are well capitalized and can offer a high level of service with a robust technology platform. Credibility, however, cannot be bought. It has to be earned. Over the years, we have worked incredibly hard to establish ourselves as one of the most credible non-bank currency specialists in Europe. One of only 2 that are listed that have both an e-money license and an investment license. The business has incredibly solid foundations, and as we continue to build and innovate, investing in technology and evolving out our product suite, the addressable market only gets bigger and less competitive, increasing the opportunity to garner wallet share. I will now pass over to Joe to take us through the financial highlights.
Thanks, Harry. So as you can see on this first slide, and just to clarify, as previously mentioned, this page covers the key financial highlights for the 12 months in bold, ended 31st December 22 as a pro forma, and then compares that to the 9 months reported period to 31st of December, as well as to the FY22 last statutory reported financial year. So as you can see, a strong performance has been delivered across the board as we continue as planned with our previously communicated investment in growth. So as communicated in January this year, revenues generated in the 12 months to December 22 were ahead of expectation at 50.4 million. And this represents an increase of 46% versus FY22. And of that 50.4 million generated, 22% or 11.2 million was new business in nature in the 12-month period, which is up 40% on FY22. The drop through from higher than expected revenues to operating profit drove a further increased adjusted operating profit of 12.3 million with a 24.4% associated margin. And just as a reminder, we do adjust operating profit for any one-off setup costs and any overseas territories, as well as any restructuring costs during the year. Adjusted operating margins are down versus FY22, as you can see in the middle of the chart. As a result of that investment in growth program, which we'll come on to, albeit again moderately ahead of already increased expectations. Corporate clients trading increased in the period to 1,749, which is up 8% on FY22. However, the primary driver of top line growth was the substantial 45% increase in average revenue traded per corporate client, driven by our expanded product offering and new channel capabilities introduced in the period, which we'll come on to in more detail shortly. Our investment in growth is being made across all 3 pillars of people, technology, and international expansion, but with the bulk of investment being in people. We ended the period with 137 global employees, which is up from 112 at the end of March 22. Earnings per share for that 9-month reported period were 6.2 basic and 6.8p adjusted, with a proposed dividend of 2.25p per share for that period, up from 2p per share in FY22. And this equates to a dividend payout ratio of 36% compared to 30% in FY22, reflecting our progressive dividend policy. If I can move on to the next slide now. In terms of trends and KPIs since IPO, these are laid out for you here. And as previously mentioned, average revenue per client was the primary driver for that increase in revenues across the 12-month period to December 2022. As you can see here in the charts, the top 2 charts in this slide, KPIs since IPO related to corporate clients trading and number of trades, in other words, volume related, show reasonably healthy upward trajectory since listing. However, as can be seen on that bottom right-hand portion of the slide, in the 12 months to December 22, we delivered a significant step function change uptick in average revenue per corporate client traded, a 45% increase versus FY22, and the highest it has been since IPO. This increase is underpinned and can be explained by the growth in new products such as structured solutions, now representing 10% of revenues, and the increased flexibility offered to clients by the ability to trade online. In other words, the significant increase in wallet share is evidence that our investment in growth is already beginning to bear fruit. If we dive into that a little bit deeper in the next slide, and moving on to the P&L, the key metrics supporting the evolution of our revenues generated across the reporting periods have been outlined in the previous two slides. The only other point to note is that momentum achieved across the 12 months to December 22 has been maintained in the first 3 months of 2023, as you will have noted in our RNS, with a 34% uptick year on year versus the same period in the prior year. In terms of our cost base, as previously mentioned, again, we've continued with our planned investment and growth strategy across those three key pillars of people, technology, and international expansion. And although investment in technology is significant, it's also amortized over 3 years in line with our accounting policy, therefore only partially reflected in the P&L through amortization. That said, we've invested a total of 1.4 million in technology across the 9 months and the 9-month reporting period to December 22, compared to 1.7 million for the full year to FY22. Investment in overseas expansion is, as mentioned before, largely reflected below adjusted operating profit due to the one-off nature of those costs and being set up in nature, again, in line with our accounting policies. In the 9-month period, we invested 500,000 in costs related to both our Netherlands and Australian overseas offices, which is excluded from that adjusted operating profit line. Again, the bulk of our investment and growth has been in people, and we mentioned earlier, we've increased our global employees up to 137 at the period end, up from 112 at March 22. Our hiring does remain focused on front office and revenue generation, as well as technology development, albeit we've also invested in bench strength across the support functions as we scale the business in a sustainable way. Average headcount grew to 113 in the 12 months to December 22, compared to just 72 in FY22. And this, together with some structural changes and inflationary increases in the salary base, drove the bulk of that increase in cost base in the reported period versus FY22. Other cost increases across reporting periods versus FY22 were as a result of our increased operational footprint across the globe, in addition to the introduction of a CVA adjustment of 1.1 million in the reporting period. If we move to the next slide, diving a bit deeper into that cost-based increase and the nature of it, I've recut the P&L to show variable remuneration, such as commissions, which from a statutory point of view, we're beholden to include in staff costs and admin costs. I've taken those out of that and shown them as variable to demonstrate that there is significant flexibility in our P&L. And on that basis, as you can see, gross margins with that definition have remained pretty consistent at just under 70% across all reporting periods. And in terms of the increase in the semi-fixed or fixed cost base, excluding these variable amounts, this is primarily driven again by the increase in staff costs previously mentioned. Staff costs were impacted by the increase in average headcount, again from 72 in FY22 to 113. In the 12 months to December 22, as well as the increase in average salaries across that time frame. The key components of the increase in average salaries were average inflationary impacts, in aggregate a 5% impact across our base. And in addition, we made some structural changes to reward across the business to rebalance basic and variable compensation, and for key senior team members, a new LTIP in order to align with long-term interests of our shareholders. And finally, we also bolstered bench strength in the support functions with an overall more senior profile in order to support that sustainable growth. In terms of the balance sheet now, moving on to the next slide, our balance sheet grew overall by some 5.6 million in the period, with significant increases in both derivative financial assets and liabilities, representative of our growing business, as well as our operating model as a riskless principle. I've drawn out in a separate table on the right-hand side to show the net cash to ARGENTEX and the movements in the period as statutory disclosures exclude collateral held at financial counterparties or have that recorded on a separate line, as well as include monies held as collateral or variation margins from clients. So once the impact of these two elements is taken into account, as that chart shows on the right-hand side, you can see that net cash has increased by 6 million in the 9-month period, with 26.2 million in cash held at the period end. If we move now to cash and cash generation, we remain a highly cash generative business. Again, statutory disclosures do include the movements in client balances in cash generated from operating activities. Therefore, I've discounted that here or normalized that here to demonstrate that we generated 7.5 million in cash from operating activities in the 9-month period before any movements in client balances held. And of this amount, as I mentioned before, 1.4 million was invested in technology across the 9 months compared to 1.7 million in the year to FY22. And as well, we did return 1.5 million to shareholders by way of the final FY22 dividend. And the business does remain debt-free with any remaining cash used in finance activities being represented by leasehold obligations. Finally, if we can just move on to the next slide, which is a quick nod to sustainability. You'll be aware that we did develop and introduce our 3-pillared sustainability strategy, pillars being people, planet and partner, as you can see. We've recorded our achievements in the statutory period against each of those pillars, by far the most notable of which being that we obtained a rating of B or good from an independent third-party ratings agency, Integrum ESG, which is also endorsed by Singers. And now I'll hand over to David to take us through the next section.
Thank you, Jill. As we've mentioned previously in previous presentations, we've got a 3-pillar strategy centered around technology and product, international and people. From a technology perspective, our objective is to innovate around the evolving needs of our clients, whilst increasing wallet share and ultimately driving open and up new revenue opportunities. We've completed phase 1 of our technology strategy back in February of last year. And since then, we've delivered the online trading platform to around a quarter of our client base. And as Joe mentioned, that accounts for about 3% of revenues. We've got some great client feedback on the product. As an example, a well-known cider maker who was time poor, wanted to trade predominantly online and only talk to a dealer when they wanted to, is over the moon with this new service combination. Additionally, structured products has tripled its revenues to nearly 10%. And from a technology perspective, the focus for this particular product set has been on the core dealing and reporting systems that underpin that particular product set. So new products are now contributing meaningful to the revenue growth story. But building on this momentum, we've initiated phase 2 of our technology strategy and built the foundation elements of our alternative transaction banking product to complement the trading systems already in place. This was delivered in Q1 of this year, and I'll come back to that a little bit more shortly. From an international perspective, our objective is to expand our client reach globally. We returned our Dutch EMI license to Passport across Europe, and this business is already delivering meaningful revenues and growing ahead of expectations. We are truly excited about this prospect in this region, as this market is around 10 times the size of the UK market. For Australia, we have an experienced management team already in place. They have developed a really strong pipeline of opportunities ready for when our wholesale license has been granted. And once this license is in place, they will accelerate into revenue production, and we expect the team to really hit the ground running. From a people perspective, our objective is to attract and retain the best talent in the industry. We're a service business at the end of the day, and our people are key in delivering this core customer value. In November, we awarded 42 members of staff an LTIP, and they are now owners of the group. This LTIP has been designed to incentivize and encourage retention, align staff with the interests of our shareholders, and create a vehicle to help attract new talents to the company. Our headcount is still biased towards front office, and we will continue to invest in people to support the strategy, whilst ensuring the culture is still world-class and evolves as we grow. Next slide, please, Harry. Phase 1 of our technology strategy was driven by the evolving needs of our clients and our desire to make our business much more scalable. By delivering this product, our clients can do all their smaller or time-sensitive trades with ease and at their convenience, with clients predominantly booking smaller trades online and using the dealer for their more complex or larger requirements. It's a win-win for both the client and ourselves, as we are getting trades that they were previously given to their banks, and they're getting a much better service. In this phase, we delivered the ability for our clients to trade spot and forward online in over 50 currencies, with access to real-time rates and giving them instant confirmations of the executed trades. It allows them to pay these currencies out globally or draw them down for a date in the future, a specific date. It allows them to see their market orders and do all their admin tasks like manage beneficiaries, see historic trades, or manage trade approvals. Next slide, Harry, please. Phase 2 of our technology strategy is the start of ARGENTEX transformation from an FX broker to a full currency solution provider. It's truly an exciting phase for the business in accelerating our multi-product strategy. As Harry and Joe's already highlighted, this strategy is already paying dividends, with revenue per client increasing 45% in the period, and additional products will only improve this going forward. Delivery of our transaction banking products allows us to fully embed ourselves into the client, making us much more sticky. We benefit from balances held on account, and having funds on account reduces our settlement risk. But the client also benefits from faster currency account opening. They get a much better service than they ever would from their bank, and when they trade from a balance, they get much faster delivery of their currency. This product is overlaid on our Tier 1 banking rails, and we've delivered the ability for our clients to collect funds and hold balances in up to 15 currencies through safeguarded multi-currency virtual IBAN accounts assigned specifically to them in their own name. So when a client needs to be paid in one of these 15 currencies, they can easily share their own bank details and see those funds arrive. And when they make a payment, their beneficiaries will see it comes from them, which is a much better bank-grade experience. Additionally, at a glance, the client can see what balances they hold by currency, and they can quickly see their total balance at any time. Clients can have their staff set up with specific access rights, limits, and signatory levels. They can manage payment approvals and see payment histories, as well as export this information to their accounting platforms as needed. Account and payment services can now be accessed online or via our PSD2 compliant APIs, making us fully multi-channel. So now a client can trade, hold, pay, collect, and manage all of their FX treasury requirements with ARGENTEX on or offline. Everything you would expect from an alternative transaction banking solution. Next slide, please, Harry. But we're not stopping there. To create a tighter focus on our market-specific needs, we've split the business into corporate and institutional divisions. This will help us drive even deeper and faster into these specific markets. And as we verticalize, phase 3 of our technology strategy will be about building market-specific products. Our objective is to unlock even higher margin revenue streams and deepen that relationship we have with our clients even further. So large clients need to make large payment runs, or they need to collect funds from a large number of investors, and reconciling this payment requests with trades is time consuming and prone to error. We can help fix this whilst also monetizing it. These products command a much higher margin, and clients will pay for this convenience and the level of service we offer. We have examples of this in our client base already, where we have what I would call mini mass payment clients, where we can get between 200 to 500 basis points for such a service, opposed to 20 to 35 basis points generally. And with a better product, we can go after many more of these clients. We've already started making progress on the foundations for mass payments, which will allow clients to upload batches of payments, have them screened and validated automatically, and associated trades calculated for approval and disbursement. This delivers ease, speed, and convenience to our clients and further scalability to us as a business. This will allow clients to do mass supply payments or investor disbursements with a click of a button. We've also made great inroads into the design of our collection capability. This will allow investors to do investor capital calls much easier and see what funds have arrived. Likewise, by adding request to pay to our corporate clients, they can allow their customers to pay in local currencies straight into these virtual IBANs, delivering the exporter market a much better value proposition. And finally, clients need to manage their FX exposures effectively, because not doing so will leave them with undue exposure. And we have started the process of analysis how we can improve our clients' management of these exposures with a range of analysis tools which we'll deliver online. We're looking forward to really making some progress on these products in the coming period. Over to you, Harry.
Thanks, David. So our transition to become a global business that offers round-the-clock coverage has taken a big leap forward in the last 6 months, specifically in Q1 this year. Since Brexit and the loss of passporting to the EU, we've relied on third-party providers to facilitate trade with our European clients. This has not only been very expensive, but also comes with a lack of control and transparency. Despite this less than satisfactory customer journey, the Dutch team have delivered revenue growth ahead of expectations, contributing £2 million to the group in the last 12 months. Following the grant of our Dutch e-money license in September, the team in London and Amsterdam have worked tirelessly to launch ARGENTEX BV as a standalone business. In March, we onboarded our first client to the BV, utilising our new European license and rails for the end-to-end trade. Now that the entity is live and we have full autonomy, we are now able to roll out the alternative transaction banking products, which will make us one of 3 non-bank providers of a Dutch virtual IBAN. A huge opportunity for not only the local market, but also for the rest of Europe, given the incredible NL IBAN prefix. We will continue to invest in our European headquarters and expect it to experience a similar growth trajectory as the UK. The team of 22 moved out of serviced offices in March into a permanent home on the canals, which has already helped attract top talent. Now, the reason why it took slightly longer than first anticipated to get the BV operationally ready was due to the prudent decision to invest in time, which will allow us to regionalise further territories more quickly. Australia's momentum has been encouraging, again using a less than satisfactory customer journey. We have been issued with a draft Australian financial services licence and expect the full licence imminently. And given the extra work that we got through in terms of getting the Netherlands operationally ready, the lead time for having Australia operationally ready will be significantly shorter. Finally, our overseas growth strategy doesn't stop here. The DNB license allows us to seamlessly passport our services throughout Europe. We are currently assessing 1 or 2 opportunities in mainland Europe. Again, we will update the market on any significant progress. Our staff and culture continue to be a differentiator and strategic weapon for ARGENTEX. It can be very challenging to retain a good culture when a business is scaling and transitioning at speed. However, our focus on our company values and employee well-being has meant that the staff are embracing this challenge. We invest in our staff across the group, and we've made over 15 promotions in the last 6 months. The current traction and opportunity is clear for all to see, and the buzz has never been better. The quality of talent and experience that we are attracting externally clearly demonstrates that ARGENTEX is becoming the #1 non-bank currency specialist people want to work at. Great people attract great people. On the hiring front, we've invested acutely in technology and change management and have bolstered the commercial teams, which are now led by Lee McDarby, who has joined the group with 20 years experience in banking and payments. Now, we are mindful that a large chunk of the group's increased costs have been people. However, we believe that the bench strength of our exec team and our UK senior leadership team is now sufficient for the next chapter of growth. So what is that next chapter of growth and where are we going? Our growth strategy will remain centered around products, places and people. David has already spent some time articulating the direction of travel for our technology and products pillar. It goes without saying that we are extremely pleased with the results from the launch of phase 1 and are encouraged by the early take-up of phase 2 and the cross-selling of the alternative transaction banking products to our established corporate and institutional client base. The implementation of phase 3 will propel us to be a truly global treasury solution. Now, as I said earlier on, our international expansion across Europe has already begun. Europe aside, we will continue to identify other geographies with similar market dynamics to the UK, Europe and Australia. and intend to acquire further licenses, which will be very much client-led. We will also deepen our partnerships with some global tier 1 banks who can give us access to new markets without needing boots on the ground. As we build out our overseas offices and they become standalone businesses, we will need to invest in people to both support and drive the expansion. As a group, we will ensure that we strike the right balance between support and drive with a bias to front office hiring. That said, with the increased levels of automation and efficiencies, it is likely that this balance will take care of itself. So in summary, 2022 was another pivotal year for the group as our focused strategy delivered record results ahead of market expectations. The 2022 investments in new offices, products, and channels have been a huge success, with impressive traction delivering ahead of expectations. What underpins these achievements is our wonderful team, both new and old. Their belief and dedication to this business has never been stronger. This momentum has led to another record performance in Q1, with revenue up 34% to just shy of £13 million. The launch of the new alternative transaction banking product set and the dedicated divisions to sell and service these products will only accelerate the new revenue streams and increase wallet share. So finally, the objective for 2023 is rinse and repeat. Onboard more clients to who we can sell more products more frequently across more geographies. Thank you. That concludes the presentation.
Harry, David, Joe, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Harry, Joe, David, we did receive a number of pre-submitted questions ahead of today's event, and as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Harry, Joe, David, if I may just hand back to you to respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Thanks, Jake. So the first pre-submitted question is, how did the SVB collapse and wider banking sector uncertainty impact ARGENTEX or its clients? Look, we don't welcome any uncertainty or disarray in the banking sector for obvious reasons. That sort of snapshot of the week where there was an awful lot of uncertainty with SVB, and we have a lot of clients that sort of bank with SVB and ARGENTEX. It would be wrong for me to tell you that the phones weren't ringing because clients were looking to move money away from SVB to a credible provider like ourselves. So we did pick up a little bit of business, and luckily we had just launched the alternative transaction banking product, so that was a great way really to drive the product and bring it to some of our existing clients' attention, whilst being able to market the product very lightly and pick up some other clients. In terms of risk, we did put out an RNS to clearly point out that we have never had a relationship with SVB. Just to reiterate, we do all our client safeguarding through Barclays and Citibank, the tier 1 banks. Next question. Does ARGENTEX offer clients own name multi-currency IBANs? If so, is this available in the Netherlands and Australia? I think we dealt with the first part, but second part, David, do you want to?
Yeah, sure. Yes, we will be. Obviously, we're in that initial launch phase with the UK right now. We're making some good headwind with getting through the initial client bases that we've identified, and as Harry mentioned, we took some additional clients on as part of the SVB meltdown. But we will be launching this in the Netherlands in the very near future, and once we have Australia through its full license and operational, we'll be launching it there too. So absolutely.
Does the profit figure today show that emphasis on growth will erode your margin stroke shareholders outcomes over the near term to midterm? Joe?
Sure. So the investments that we're making in growth will be have been primarily felt in this last reporting period, as well as into the annualization impact of that into this year. Over that medium term, we've already started to see those investments bear fruit, as we mentioned earlier. And the products that we're investing in do carry a much higher revenue per product and much higher margins per product, and therefore the combination of those will positively impact operating profit and earnings over that medium term period. In terms of shareholder outcome, we maintain our progressive dividend policy, and you can see evidence of that in the dividend proposed for the 9-month period at 2.25p per share.
Thank you. Next question. In their full results presentation, Equals Group illustrated the evolution of their marketing progress with a chart showing ARGENTEX well behind on their product platform access. Where would ARGENTEX position itself on this chart? Now, I haven't seen this chart at all, and clearly Equals haven't seen this presentation before they probably wrote that chart. I think the takeaway here is that often there are 3 listed businesses, I guess, in this space, or potentially 4. We're all very different. Equals being very different to ARGENTEX, with their average trade being around about £30,000, whereas ours is just over £500,000. Their focus is SMEs, smaller SMEs, and high tech and cash cards. Example, we're totally on the other end of the spectrum. So we're on the sophisticated corporates, the institutions, but I can understand why investors would probably bucket us all together. But hopefully we demonstrated in the last sort of 40 minutes or so that our product suite has come on a long way, and also sort of showing what's in the pipeline. And this isn't stuff that is potentially coming your way or client's way or our way. This is stuff that actually has been developed or is being developed. So it is incredibly exciting. So another question: how are you finding talent acquisition at the moment? I think the majority of hires that we've made over the last 6-9 months have been in technology. So I guess it's probably better for David to answer that question.
Yeah, I think it's been fine. There's been decent tailwinds when it comes to acquiring talent on a number of fronts. One, we're doing incredibly well. We're cash generative and we're profitable, but we still have a startup mentality. So attracting staff to this type of organization in the current climate is relatively straightforward. Obviously, there's a lot of land grab for talent out there, but we've been able to attract people from banking, from other NBFIs and similar competitors, right the way through to people that exist within other parts, and in fact, clients like funds. So we've never seen any major issue with respects to hiring. So and long may it continue. And I think with the pressure on the fintechs to get to profitability, a lot of them are either letting people go, or in some cases they went bust or being bought out for nominal fees. That's just pushing more talent into the talent pools, and hopefully we can hoover a few more of them up and give them a great home to come and live in.
Thanks, David. Can you explain why growth in structured solutions is an opportunity for higher margins? Sure. So structured solutions, or effectively options or derivatives, are really presented to a client for hedging purposes. They're not there for speculative purposes. They are there really for clients that have or draw upon a broad suite of products in order to protect their risk, but do allow some sort of upside if the market were to outperform. So we have a separate division or desk that looks after our structured solutions. They work alongside the dealing team. But whenever a client mentions options or structured solutions and they want, the dealer would want to sort of take it to the next stage, then it has to be that structured solutions division that takes on that conversation. And the reason for that is that it is an investment product, so it has to be dealt with the right people. There are opportunities within structured solutions to increase the take or the spread. There are other opportunities where if options aren't knocked in or knocked out, it does give you a sort of second bite to the cherry. Therefore, that's why you see the average spread between a forward and the options being there's quite a big disparity between those. Now, I think I've made it very clear in the past on these investor roadshows that we very much don't want to become a structured solutions business. But what we are trying to do is we're making sure that we have all the products, all the tools in our arsenal that allow us to facilitate the clients as per their requirements. Does macroeconomic uncertainty impact your expansion appetite? I mean, from a CEO point of view, I would say no, but maybe from a CFO point of view.
Yeah, sure. I mean, I think we've demonstrated our ability to flourish in any market backdrop. If you think about the number of so-called black swan events that we've withstood over the last 11, 12 years since inception, I think, for a business like ours that's highly cash generative, over 80% of our revenues convert to cash within a 3-month period. And with the cash that we do have the benefit of holding and available to us, it's exactly the right time. I think cash-rich businesses do well in environments like this. So it's very much the right time to move with our expansion plans.
Thanks, Joe. David, one for you. What exactly is alternative transaction banking?
Okay, no worries. I think to describe alternative transaction banking, you've got to take a step back of what is transaction banking. And this is what I'll call the boring side of banking, where it's about addressing the day-to-day operational needs of a business or an institutional customer. For example, delivering currency accounts, clearing and settlement for FX, and payment and collection services, the rails, for want of a better term. And these are services which facilitate the safe transition of money from one country to another, as well as offering risk management and cash management services. And typical providers would be the likes of Citibank, Deutsche Bank, and the likes of Goldman's more recently. When you deliver services through these types of players, what you end up with is 2 platforms. As an example, with Barclays, you'll end up with Box with their investment banking side, Barclays Capital, and then Group, you'll end up with the payment services. And it's the same with Citi. You'll end up with WorldLink on one side, and you'll end up with Velocity on the other. And what we try to do with this alternative solution is create an environment where you have one platform servicing all, and then overlaid with your specialist teams, as Harry said. So whether that be your account manager who understands you and your services and your business intimately and your needs, as well as the overlay teams like the structured solutions teams, which can deliver them specialized products. So we're trying to deliver a much higher level of service, the right level of product, the right level of tech, and the right level of service, depending on the client need. And that's why we call it alternative rather than just the basic transaction banking.
Thanks, David. Joe, one for you. Why are you holding so much cash, and will you pay it back to shareholders?
Well, I think there's a few answers to that, or a few components to that answer. We do hold a significant amount of cash, part of which is to fund any short-term cash flow requirements as we, with every trade that a client places with us, we place an opposite trader with our financial counterparty. As those positions do and can go, out of the money, we do have to place variation margin with our financial counterparty, which we then recoup from the client. But there is that intervening period whereby we 2 to 3D window whereby we have to cash flow that. So we must maintain a certain level of buffer for that. We do have to maintain as well, buffers for reg cap and so on. But that said, I mean, our focus and emphasis in terms of cash utilization moving forward will be focused on growth and funding that growth strategy. But equally, as I mentioned before, we do maintain that progressive dividend policy, and will be returning funds to shareholders in line with that.
Thank you. Next question is, when will Australia be revenue generating? So as we mentioned in the presentation, we already have a team on the ground in Australia, and they are actually already generating revenue by introducing business to the UK. We then have to onboard that Australian client in the UK, and we have to trade that client in the UK, which clearly, with the time difference, is less than ideal. But with the AFSL and us going through that process of making Australia operationally ready, which is sort of I don't want to put too much of a timeline on it, but 3-4 months away, best guess. But I'm not the regulator. That will allow the team over there to really sort of hit the ground running and start to onboard clients to the Australian entity, the PTY. And as the Netherlands have started doing as of March, onboard the client and trade them end to end. So when will revenue be generated? It actually already has been generated. I probably guessed that the question meant to say, when will it be meaningful? I guess sort of Q4-ish this year is what we're looking at. Final question is, why have 2023 and 2024 not upgraded given your recent performance and confidence? Joe?
Sure. I mean, I think we're very pleased with our recent performance, and the results are encouraging. Showing early evidence that our investments are already starting to pay off. However, I think looking forward, we have maintained conservatism in the guidance that we've provided. We are well underway in our technology strategy development and the phases that David articulated earlier. With phase 1 complete and phase 2 just launched and phase 3 just beginning. So I think the short answer is, early signs are very positive, but we'd like to maintain a little bit of conservatism around, in particular, the timing of some of the licenses being granted in the new territories, as well as adoption, rollout, and execution of the new strategy along the way.
Thanks, Joe. Thanks, Jake. I think we've answered all the questions we sort of can answer, some of which I haven't answered because they're probably written during the presentation. But
Harry, absolutely. And Joe and David as well, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses on the Investor Meet Company platform. But Harry, just before redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yeah, thank you very much for your continued interest and support on ARGENTEX. When I said earlier on that, really what's underpinning this business is our staff. Quite frankly, they've all been brilliant. Everyone is very excited about the coming year, with all the products coming online, the new geographies coming down the line. So we've never been in a better position, and we look forward to delivering and in turn, obviously, paying back to investors in the next year or so.
Harry, that's great. And David and Joe as well, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ARGENTEX Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.